Anaplan or Plan Stock just announced that they're going to get acquired for a huge premium over where they recently traded. This might mean great news for software as a service investors or SaaS stocks, and we'll talk about this and more, as well as several of the top SaaS companies and what their current valuations imply. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in any of the securities mentioned. So look, what's the news? The news is that Anaplan or Plan Stock is going to receive $66 per share in cash from Thoma Bravo, a private equity firm. So this is a $10.7 billion deal, representing around a 46% premium to where it recently traded. And you can see it's currently trading on around 12, 13 times sales during the last 12 months. But that premium, this 46% premium, means you're going to be around here in terms of the high teens. And so at $10.7 billion, around the $66 a share, you are going to see a jump in Plan Stock. This does imply around 20 times subscription revenue. And keep in mind, they're growing at 30% plus, and they're guiding to, see, it's always about that forward growth as well. They're guiding to 26% growth in the year ahead. Now, it is worth, calling out that they haven't really hit scale yet in terms of profitability. You're looking at negative free cash flow, and you are looking at a cash burn in terms of their, basic GAAP operating expenses. Now, does this potentially mean that a lot of different SaaS stocks are on sale, given that you have private equity investors stepping in? And look, I think this is a really important aspect, and this is where I try to keep it real with this channel, is that there's a lot of investors out there. There are a lot of YouTube channels. Some just ignore valuation outright, and that's how some people invest. Other folks, try to say, hey, let's try to do a really academic approach to investing. I'd argue that works for academics, but what really, drives investing, and that's partly what I try to do with this channel, is share my own personal experiences working in a multi-billion-dollar hedge fund and say, hey, this is the ballpark figures, this ballpark framework that major, institutions use to consider when they're looking at companies. And so one of the aspects that when it comes to company valuation that you consider, not only a range of possibilities in terms of, free cash flow multiples and things like that, but one thing people consider, because at the end of the day, you get a full range of potential valuation frameworks. It's not this academic DCF where it's like you change something by a little bit and you end up in a different galaxy. What's interesting about valuation in this case is that a lot of folks are going to be looking at this deal with Thoma Bravo and Anaplan and saying, hey, this is the private market value for some of these SaaS businesses. What does that mean for all the others? And I pretty much all the major hedge funds out there that do have SaaS investments are going to be looking at this week, possibly right now, to say, hey, where does our portfolio stand relative to this deal? What does their growth rates look like, and what is the underlying valuation? And so let's actually do a couple of companies, so that way you can see, what I'm talking about, what I'm thinking. So for example, Docusign. I've done a video before on Docusign. They trade at a significant discount. You saw where, Anaplan was currently around like 12, 13 times. Now it's going to be closer to 20 times, for their recurring revenue. So here it is. Docusign's around 9 times sales. They're similarly unprofitable, but they also have a lower growth outlook. So part of this discount is warranted, where they're only looking at 18% growth in the year ahead versus, mid to high 20s that you are seeing from Anaplan. Then you look at a company like Veeva. Now, Veeva is the cloud solutions provider for global life sciences industry. They trade for relative valuation premium. You can see how last 12 months, it's around 16 times last 12 months sales. This is not getting this is where it's publicly traded right now. Once again, I mentioned that this deal for Anaplan is around 20 times subscription revenue, but based on just where it's publicly traded, Anaplan was originally around 12, 13 times. So this is a bit of a premium. Now, it is worth understanding. Look, Veeva is growing slower. They're only growing at 25%, and they're guiding for much slower growth, around 18% subscription growth in fiscal 2023. So that's their year ahead, because their fiscal year, I believe, ends in January. Both of these growth rates, both the last 12 months and forward-looking, are slower growth than Anaplan. But this is the saving grace for Veeva, which is that they're much more profitable. They've already proven their scale. You're looking at non-GAAP profitability of around 40% margins, which is quite high. Now look at another company. I've talked about Twilio before. Twilio, TWLO stock, they trade at a much lower multiple, around 10 times sales, And they're guiding to even faster growth, which might make you think, okay, this is potentially a really good deal. But then you have to, recognize, okay, something's a little bit different here. Something's a little bit off here, because Twilio's long-term profitability is also likely to be much, much lower than Anaplan, as their gross margin structure is around 50% versus Anaplan's gross margin is around 75 to 80%. So this means long-term profitability for Twilio is likely to be much, much, much lower than Anaplan as well. So that should affect what type of valuation. Next, look at another major SaaS stock, Zoom stock, ZM stock. It's interesting. COVID pulled forward most of their growth. You saw this huge jump in terms of valuations that folks were willing to pay for it. And you saw that it was trading at over 100 times sales last year. That obviously the stock has come in significantly, as now it only trades around 8 times sales. So this is, all these charts are by Koifin. If you're interested in checking that out, they do a great job. I don't get any sort of income at this point from Koifin. I'm just calling out because I think that it's a good product. But you see how the price of sales has declined significantly. They are still expecting around 10% growth next year. That's what they're guiding to. But they do, this is where it gets interesting, is they trade at real earnings because they are really profitable. They have around 25 times real earnings. So that's not sales. The question is, how much growth do they really have from here? Whereas when you're paying for something like Anaplan, you're paying for years and years of continued high growth. What's my take on all this and potential SaaS stocks, and is there a potential bid from here? First, a quick plug where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies for both good and bad times, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com, click join the journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Okay, so let me share my own personal take, on this. I've scribbled some notes here that I'm thinking about. So I think it's worthwhile to take a step back, before you even think about Thoma Bravo, private equity stepping in. I think, as I've called out in a couple of videos, I think we're living in a new era. I think a lot of investors have seen easy central bank policies. And so I think looking at a new era of potentially much higher inflation than what you're accustomed to, what does that mean for valuations? I think folks need to think about that. What could that mean if we live through an era of slower growth and higher inflation, negative real yields for prolonged periods? What about a central bank that is less friendly to the stock market than what we've seen for the last, let's say, decade plus? What if you look at potentially rates moving higher in the months and years ahead? And arguably, you look at all these potential headwinds, potentially dealing with a valuation headwind, valuation compression in the potential months and years ahead. So that is sort of the backdrop in which I'm considering this, saying, look, this macro picture is a lot less friendly than I think a lot of investors have experienced and benefited from over the past decade. And so that is something worth considering. So my own personal journey as I look at investments is that the bets that I personally want to make, the big bets that I want to make sure that there's a real valuation backstop. I want to make sure if I'm buying something that it's trading at a nice multiple to free cash flow, like a company trading at 10 times free cash flow, or a company that trades at a 30% discount to book value. Those are going to be the things that ideally they're unrivaled companies, or they have a very strong value proposition, a history of execution delivering, but ideally they also have this sort of valuation discount as well. That's personally what I want to look at. The other data point, while you might think that Thoma Bravo, private equity industry, might step in, provide this sort of backstop in terms of how low stocks can go from here, it's also possible, that while that scenario is a rosy scenario, hey, they're going to set a floor. These stocks are going to bottom out, let's say somewhere between 10 and 20 times sales. That's one sort of rosy possibility, and you might see a bid on SaaS stocks because of this. I would say it's also possible that they're mistaken. You do have, private equity firms, overreach and sometimes overpay for things because they've seen, favorable conditions for so long. So I think it's important to consider both sides. One aspect is like, hey, this might set a floor in valuation and arguably create upside potential for a lot of these SaaS stocks that have been selling off. I think another angle to consider is, maybe they're overpaying and it's going to result in lousy returns for them. I think what I'd love to hear from you, and we'll continue on the Discord channel, the exclusive Discord for Unrivaled Nation, the Unrivaled Investing. The question is, I've covered several companies here in this video, very high level, sort of saying here's the growth rate, here's the valuation, here's the margins potentially, what's potentially interesting. And Anaplan is kind of interesting, just given what valuation they're effectively paying. Here it is, around 20 times sales, forward sales. That's that's rich. That's really rich, and that's the reason why I think it's a bit of expensive, and it's possible that they're overpaying for this. And so that's the reason why I'd love to hear your thoughts on, are there SaaS stocks where you're like, wow, Daniel, this company is growing way faster than Anaplan, and they have a better margin structure. Here's a SaaS company. So feel free to leave a comment below if you feel like there's a company that I should be checking out that has better growth. Let's say 20 to 30% at a minimum, and trading at a lower multiple on, let's say, a price to sales multiple. I'd absolutely love to hear it. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.